Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastop Jr.
Hello and welcome back to the Ask Ralph Show. Today I'm going to tackle a very fun and interesting topic. No, I'm just kidding, but it is exciting for people who do this type of work. And it's something that I do get asked a lot about in my practice. So I thought I would spend a few minutes today talking about the term step up in basis. And before I lose everybody, what we're really talking about here is something that can be very beneficial at tax time. And what we're talking about is the term stepped up basis basically relates to capital gains that you can save considerable money when you decide to sell an asset or property you've inherited. Step up basis is defined as such. So let's use a real simple example. So let's say that your grandfather passed away. And as part of that, him passing away, he left a will, and that will left you with his home. Okay, so grandfather passed away, you were his favorite grandchild apparently, and he gives you this home as an inheritance. Okay, so the first thing we need to think about is, how do we arrive at what we call this stepped up basis, and why is it important? Well, basically it's going to work like this. When you inherit your grandfather's house, and let's say you don't plan to live there, you plan to sell it because it's in another town or another state or something like that, and you say, okay, well, I'm going to go ahead and sell that asset or sell that house. Well, there's a tax consequence to that because you're going to sell it. Now, the way you determine the tax on this particular sale is the difference between what you sell it for, the net proceeds, and what your, quote, basis is in the property. Now, basis is what you paid for it, and in some cases, the cost of any capital improvements you've made. And you pay capital gains tax on the difference between the sales price and your basis when you sell the property. Or you could have a capital loss if you sell the price is less than your basis. So if you inherit this property from your grandfather, it gets stepped up basis. So let's talk about this example, okay? So let's say you've inherited a house from your grandfather and he paid $50,000 for the house 30 years ago. You don't want to live in the house or go through the hassle of renting it out, so you put it up for sale. So let's say a month later it sells for $400,000. So under normal tax rules, you would owe capital gains tax on $350,000 in profit. Where do I get that? Well, the $400,000 is the sales price, and your grandfather paid $50,000 for it. So the difference between the $400,000 and the $50,000 is $350,000. So then you would pay capital gains tax at a rate of 20% or more on that profit, depending on how much other income you have on your tax return. Now, let's look at that same example with what we call step-up basis. So even though your grandfather paid only $50 for the house, it was valued at $350,000 at the date of his death. And see, that's the key to this. When you inherit anything, could be a house, could be stocks, could be bonds, could be anything that is not pre-tax things, you need to get a valuation as close as you can to the date of death. Now, I'm not saying, the day your loved one dies that you run out and get things valued. But what I am saying is that you need to make that a priority as part of your estate. And you would be shocked how many people don't take the time to do this. And then a year later, they go to sell that asset and they have no idea what that asset was worth a year before. Now, if it's a stock or a bond, those things are a little bit more simple because they actually have, what they call historical stock quotes, where you can go on to an online site and you can say, okay, well, my grandfather left me Exxon stock and he died on March the 4th of 2018. Well, you can go and see what the price of that stock was on that date. But let's talk about something that's not that simple. So let's say it's a house, okay? So getting back to our example. So even though your grandfather paid only $50,000 for the house, it was valued at $350,000 at the date of his death. That becomes your stepped up basis. So think about in our first example, your basis was $50,000. Now we're talking about your basis being the value that it was on a date of death. So that could be as simple as calling a realtor and having it valued and say, listen, now if I was to sell this house today, what would that house be worth? And get that in writing, because you may very well need that if you get audited by the IRS. And make sure, it's clearly laid out. with the, the existing market conditions and all that sort of thing. So in this scenario, your stepped up basis is now 350. So now you would only owe capital gains tax on $50,000 in profit. So that's a big deal. Now, one of the things I will tell you is in some cases, you actually may trigger a capital loss. So let's think about a little bit different example. Let's use the same parties. So your grandfather passes away and the house is valued at $350,000. Okay. Well, then all of a sudden the market takes a hit, or let's say, something happened in the area where your grandfather's house is located. It could be a whole host of things. Now, the first thing I will tell you is if you're going to try to take a loss and there's a short period of time between the time it was valued and the time that you sell it, I think you need to be really careful about whether that was a legitimate valuation at that time. But let's say, for our example, you inherit your grandfather's house in 2018, okay? And it takes 3 or 4 years to sell it. Because let's say, for example, you had to do some, improvements to it. Grandpop didn't do a lot of improvements. You have to get rid of the avocado green appliances and things like that. Or let's say that, you do a home inspection, your potential buyer, and says they found this problem. So time goes on. So in other words, you've got that $350,000 valuation on the date of your grandfather's death, but now we're 3 years later, and now all of a sudden you sell it for net proceeds of $300,000. Well, what do you have now? Well, now we've got that basis of 350, and let's not even talk about any improvements you may have made to it. Let's just assume you didn't. Now you've sold it for $300,000. So now instead of that capital gain, you actually have a capital loss of $50,000. That's a legitimate capital loss. Now there's a whole discussion about, the impact of that, because there is a limit on the amount of capital losses you can take in a particular year. You may have to, it's basically a maximum of $3,000 unless you have other capital gains. So the idea of step-up basis is really a valuable one. So, if you're fortunate enough, or unfortunate enough, someone passes away, but if you're fortunate enough to be the beneficiary of an estate, you need to start asking questions about the value of the assets in that estate. And then make sure that you're letting, let's say you work with somebody like myself, and let's not use a house as an example, but let's use an investment portfolio. And let's say your Aunt Louise, left her investment portfolio at, Merrill Lynch, let's call it. I don't even know if Merrill Lynch still exists, but let's just use Merrill Lynch as an example. And, on the day that she passed away, the broker said, okay, well, the valuation of these stocks and bonds was $200,000, just make it simple. You need to know that, and you need to know the individual components in that, because let's say that at the end of that tax year, you sell some of those stocks. Well, let's say that the broker didn't do a good job of keeping track of that step-up basis. Well, you could very well pay tax on income that you don't have to pay tax on because you don't have that step-up basis. So this is just something that I get a lot of questions about. People pass away and people inherit things, and it's just one of those things you need to have a basic knowledge of. But the key to this is making sure you get those valuations so that you know what that value was on the date of that person's death.
You've been listening to Ask Ralph, brought to you by Sazio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Sagio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.